Hello. If you recall, about 1.5 months ago, I think I told everybody that I really don't like formal dressing suit up. I would like to dress in a more casual way. Now I'm pretty casual, probably too casual, but you know, unfortunately, it's in my house rather than in our campus. Like I said, I think online teaching, especially for advanced accounting, it's very inefficient. Although I like although I hate, I like the fact that I don't have to drive all the way from Sugar Land to the campus anymore. But still, for the job, from the job perspective, for my own work, I would love just for us to meet in our classroom and talk about advanced accounting. But unfortunately, at least for this semester, I don't think we can do it. Um, okay, I'll try to make this class more interesting. In last class, we talked about some basic knowledge about partnership accounting, focusing on what should be different accounting-wise for partnerships compared to corporations, right? So today we're gonna go in a little bit more depth and cover how to start up accounting-wise, how to record, how to generalize so the foundation, the startup of a partnership. Oh, I don't want to be a spoiler. And let's move the thing up. What to know about starting your small business? I think many people had this idea before, right? I always want to start my business and did some and doing some. And a lot of people, I think at some point in time, when you're really good at some stuff, when you really know what you want to do, and when there's good opportunity, when you know certain people, maybe it's time for you to do it. And when you start, because you don't have $1 billion trust fund or $1 million trust fund behind you, so probably you will start a small business partnership, LLC in the partnership, LLC, small business LLC. You will start doing that, right? So let's talk about if we want to start, how to start a small business in particular partnership, right? So for you to start, for us to start, I think the most important thing is an idea of what business you want to be in, right? You need to know the business and you want to make sure the business can potentially bring you money, meaning that you are not the only one who likes the product, the service you're going to be providing. And there are not too many people able to do as good as you are, right? So that's pretty clear. So if you want to choose a business, there are certain things. For example, if you like fried chicken, if you know every secret, if everybody tells you that you make the best fried chicken, whatever they like, right? That's probably not fried only, but if you make the best one, then everybody tells you, hey, you should do it, you should do it. I'll be working with you together to do it, right? So maybe it's a good idea to do this, right? This is a legal business and you have the potential to grow bigger if everybody really loves it. So this is good, right? On the other hand, I would rather you want to stay away from the illegal one, right? Because illegal ones, you dodge away for a while from IRS, but there's much more problems associated with it, subsequent consequences associated with it, right? And I don't think about doing a business that do both legal and illegal, because you're never going to end well as well, right? So that's the first thing we need to know, that we want to make sure we know what we're going to do, and it's a good business with some potential in it. Then after this, do you want to do it alone? With the exception of certain business and with the exception of certain people. Most people want somebody to work with, right? And which means you need to find partners, right? Partners are very, very important. I mean, when you think about partners, it's not like, hey, I'm good buddy with that person now, I have to work with him, right? Or for example, I know him for my lifetime, he's my neighbor, we live really close, we can discuss every day in the sense. That's not what you're looking for. Right? You need to think about, for this business, what resources do we need? Not only for current operation, not only for starting up, but also for future growth, right? in addition to the business, the industry itself, what else is key for business? You need people with money, with resources for sure, right? And you need people with a little bit of managerial experiences to manage, have about managing business, right? And also you need some hardworking people who's ready to be here, be there, and be with the company all the time, care about it, operate it, right? Operate it. So those things becomes important, and you are looking for partners with at least one or best more couple of those qualities, so you can have a healthy business to start with. So after gathering these, what else is important? You have resources, you have different resources put together, you know what you're going to do already. And I always let people know, right? Oh, in China, what do we say? I believe in America with a similar thing as well, right? If you want to make your best friend your enemies, if you want to never talk with your relatives again, with your cousin again, with your nephew again, for example, what do, right? Solution number one is become roommate with them. We probably know that already. And solution number two is what we're going to talk about is to start a business with them. Why? Because right, when business is just starting, everything's fine, everything's not too good, not bad, goes smooth, people are fine. They just respect each other because they see hope. They want to work with each other. Everybody wants to be are in for the same direction. Right? When your business is small, there's not too much future different paths for you to follow. However, if business keeps like this, never grow, never decline for a while, people might have other minds. Right? And that's not the worst part. The worst part is if business goes good, everybody, as human nature, everybody wants to take credits for themselves, right? Everybody would think, truly, honestly think they made a more contribution than the other people. Because I was here the whole day, the guy comes here only once every other day, some stuff, right? I talk to clients a lot. The guy don't even know half of our clients, those things. So people will try to take credit. When they take credit, they want to take more money, they want to do stuff, business goes down, right? And if business goes bad, that's bad as well, because people will start to point fingers at each other. You're the one who ruined this, you're the one who screwed up. So to avoid such, right? I'm not saying that it's a bad thing to work with your friends, it's a bad thing to work with your relative family members. It's not necessarily a bad thing, as long as you have charters and aka rules, right? So problem if business started with your friends and family members are most likely to fail. A lot of them fail is because people think, okay, it's my friends, it's my family, we're gonna sort everything out anyway. So they ignore it before they start. They should talk about those rules. And what are those rules should be, right? Like we talked about, if we make money, how to cut the pies, distribute the pies among different partners, how to recognize contribution, right? How to recognize how much people invest in the company. When the business goes bad, how should the people take responsibility? Thinking about all scenarios. Meanwhile, for a business to grow bigger in a healthy way, every year if you make money, you need to retain some capital in the company to make the company grow bigger. So they will talk about the capital retain, and they will talk about the policies to encourage partners to retain more money in the company. Those different rules we're going to talk about later. But like I said, we all know what happens if there are no rules for a company. You can see that those who used to be on a team, they're going to fight each other in a pretty fierce way. So here comes an example, all right? We're not going to talk about the rules or whatever for now. That's going to be for the next class. Today, we're just going to talk about starting up of a company. What is starting up of a company? Basically, different partners with different things to resources a company needs. When they contribute to form a company, how should a partnership recognize everybody's contribution in the accounting sense, meaning that how much, what they contributed and how much they contributed, okay? So here's a problem here. January 1st, 2010, Adam, A, Betty, B, and Carl, C, formed a partnership. And their contributions are, Adam contributed with 100,000 cash, Bethy contributed with land with a market value of 80,000. However, notice land also carries a 30,000 liability alone that will be transferred to the partnership. What does it mean? Meaning that Bethy, although she contributed 80,000 land value, but she didn't pay off 30,000 of the 80,000, right? So this Bethy, by contributing this piece of land, will also shake off the unpaid loan and give it to the partnership. Partnership will be responsible for the loan. And Carl only contributes 20,000 inventory, but different from other people who are relatively new and green in this business, Carl has expertise in running the business. Right? He might have clientele information, he might have connections, he might be working in the business for over 10 years already. So Carl has expertise, right? And if you want a business, do you want somebody like Carl? I think probably yes, right? Because they are so precious. So meaning that those expertise, they're actually worth some value. And here we are saying that which is deemed to be worth 30,000 by all the partners, A, B, and C, meaning that they agree upon the value. So if you recall the first half of our advanced accounting class, what does this 30,000 worth expertise look like? If you think about it, it's looking like goodwill, right? And we know that for corporate accounting, goodwill is not recognized until merger and acquisition, and we call them goodwill, of course, not expertise. However, in our setting, remember, it's a partnership, right? Why, I would bring one, why a company, a corporate cannot recognize its own goodwill? Because for a corporate, there are so many people, especially for a publicly traded company, there are so many people's stake in it, right? And their interests are involved. And it's very difficult for some like expertise value, whatever value, everybody management comes with expertise. So it's not practical every time there's a new guy management coming in and all the shareholders discuss how much this guy is worth, because not many people don't have the information to determine or ability to determine management expertise worth. And also it's impossible if you think about thousands and tens of thousands, hundreds of thousands owners, shareholders to have a meeting discussing those things. So for corporate accounting says, okay, those things are not just recognizable. Okay, we cannot recognize those on our financial statements as our assets. But for a small partnership like this, it's not an issue. The three of them can easily have a meeting, right? Carl says, okay, I'm important. I think mine was 50,000. And other people add them, and Bethy, of course, will tell them, I don't think it's that much. I'll give you 10,000. So they will reach an agreement here in the middle, 30,000. So A, B, C, they all agree that the value is 30,000. So for partnership, it's not affecting so many people, and arriving at a conclusion of how much the expertise is not so difficult. So for partnership accounting, AICPA, those rules, they basically tell us, okay, you can choose accounting method that allows those expertise to show up as assets under the name of goodwill. So we can see this, right? So here we can have, okay, what the company has after contribution. The company the company had a cash 100,000. That's what it got, right, for operation. And if they will have inventory worth 20,000, and the land worth 80,000, and how much? In addition to 20,000 inventory, Carl also added expertise, which would be named goodwill, 30,000. Everybody recognized it, right? And then when companies had all these, where do they get these again? So we can see that, okay, first, there's going to be a loan, because a loan attached to the land now is transferred to the partnership with the land. So we will credit a loan for 30,000, and there's then everybody's contribution capital, right? For A, it's fairly easy. A contributed 100,000, that's 100,000. And B is kind of Bethy. It's a little bit complicated, because B, although contributed a land worth market value of 80,000, but we have to know B, Bethy also shake off 30,000 liability. So Bethy's net contribution is 50,000. And for Carl, it's 20,000 tangible inventory plus 30,000 intangible, not even intangible goodwill, which is 50,000 to add it up together, 20,000 by 30,000, right? So this method allows partnership to recognize goodwill as long as everybody agrees upon the value on their financial statement. So we call this goodwill method. Then of course, some people might say, hey, we don't want to do goodwill method because it's so complicated. We just like to, to follow corporate because we are ambitious. We want to make our company partnership grow bigger, and essentially we're going to adopt corporate accounting. So why don't we start like this? And a GAAP allows that too. And what is corporate accounting rules again about goodwill? Is that whenever you have your own, with exception of goodwill being established during merger and acquisition, no company can recognize their own goodwill. Here, this partnership formed by A, B, C, Adam, Betsy, and Carl. Although Carl brings expertise and everybody agrees its value, but if they didn't choose goodwill method, then we are saying that goodwill will not be allowed to show up on balance sheet. So here, let's take a look again. So knowing all these, what is this partnership got after everybody contribute? So we know that there's cash 100,000, inventory 20,000, land 80,000, then no goodwill, right? And also we know for sure on the credit side, there's going to be loan attached to the land, 30,000. So here comes the issue. What is everybody's contribution for this company and how much are they, right? So recognizing goodwill or not, imagine this scenario, right? Some people might say that, okay, it seems if we don't allow goodwill, then Adam contributed 100,000, Betsy contributed 50,000, and the Carl contributed 20,000. But let me ask you, if Carl's capital in the partnership is limited by so much just because they chose an accounting method that would not allow goodwill to show up on balance sheets, would Carl still be part of the company? If you were Carl, would you be part of the partnership? Although you have pack of expertise, but they don't recognize it, and it's counted for nothing. You're going to work hard and you don't get anything. Would you be happy with that? Probably not. Would you be in a partnership with them? Probably not. Right? So this is not fair for everybody and for anybody, and we want to make this method still being chosen by some partnerships. So what should be the capital of everybody is? Let's think about it. Right? Remember, I talked about sharing the pie. I said, right? No matter you are getting 2 slices, 1 slice of the pie, we have to think about how many slices is a pie cutting, right? If you cut the pie into 2 pieces, half, then 1 slice means 50%. If somebody cut the pie into 4 equal slices, right? So each slice is worth 20%, 25%. Then under this scenario, getting 2 pieces doesn't mean that you get more, because getting 2 pieces out of 4 still means you got 50% of the pie. So the same, right? So if we look at this company, no matter this partnership recognize goodwill or not, right? They still have the cash, inventory, land. If the company really partnership is formed, they will still have 4 partners. They will still have the loan over there. So they are still the same pie, no matter you choose goodwill or the non-goodwill method. They are still the same pie. And of the same pie, if we look at a goodwill method, we know that accounting expertise, right? A will have 50% of the pie. Right? The total capital contributed here is 200,000. 100,000 plus 50,000 plus 50,000 is 200,000. Then A has 100,000 out of 200,000. A will have 50%. B will have 25%, and C will have 25%. Right? So even if goodwill is not allowed to show up, but remember, given all these things, it is still the same pie. It's just because we measure the total equity this time is here we have, oops, sorry, spoiler alert, 200,000, 30,000. So which means we know that the total equity of A, B, and C should be 130,000. And of the 130,000, it's still the same pie. So no matter how much we value it, A should still have half of 170,000, which is 85,000, and B and C each will have 25% of 100,000, which will be 42,500. Right? And what do we call this method? What do we call this method? So let's compare the capital under everybody's name. And let's compare this to how much they contributed, which were recognized, allowed to be recognized under this method, right? So if you take a look, the capital under A's name was 85,000, and A contributed 100,000. So compared to how much A contributed, A got 15,000 less, and Betsy got 75,000 less. However, the capital under C was 42,500, although under this method, Carl is deemed only contributed 20,000 worth of inventory. So for Carl, he got 25,500 more than he contributed, right? And if you add 15,000 here, 7,500 here, it's a number. They will add up to minus 22,500, which will equal to number-wise, magnitude-wise, 22,000. There's a further 500 here. So what does it look like, right? It doesn't look like, okay, A and B says, look, Carl, right? I know GAAP doesn't allow us to recognize goodwill on our balance sheets, but we appreciate your expertise, right? And to keep you with us, to show our appreciation, we will remove some balances out from our capital, and we will give it to you as bonus for your expertise, for your contribution. So in this process, Carl basically says, you know what, I contributed 100,000, I will take out 15,000. And then B says, you know what, I contributed 50,000 value, but I will take out 7,500. So together we give you 22,500 more as bonus for your expertise. And with the 22,500 more plus the 20,000 inventory, Carl's capital under this method is brought up to 42,500 as well, right? So this thing is like a bonusing process, right? People A and B, they are paying bonuses out of their own name and give it to Carl, who brought with importance, but unfortunately not recognizable under this method of assets. So this is called bonus method, all right? These are journal entries under both methods, which talks about the journal entries for the setup of the partnership. And in next class will be longer. I'm probably gonna make a very, very long video, or I will just make half of it. We're gonna talk about the foundation of a partnership, how partnerships grow bigger, how partnerships, when they grow bigger, sometimes they go downhills and bankruptcy, all these issues. Just wait for the next video, all right? Take care of yourselves, guys. See you next time.